This is your host, Caitlin Cook, and welcome back to the Dead Kate Bounce experience. This week's guest is the one and only DeFi Dad. As you might have guessed from his name, DeFi Dad is an early DeFi super user, as well as an educator, investor, and host of the DeFi Talks with DeFi Dad show. Now a partner at Fourth Revolution Capital, he invests in early-stage DeFi, Web3 media, and Web3 gaming projects. DeFi Dad and I discuss what beginners need to know about, well, you guessed it, DeFi. Decentralized finance is a term used constantly in the crypto space. We define DeFi in plain English, as well as discuss the most common ways in which a crypto beginner will be exposed to DeFi innovations, current issues being faced in the space today, and more. This is often made to be an overly complicated topic, and I can confidently say that this is one of the best DeFi primers I've ever heard to date. With that, please enjoy my conversation with DeFi Dad. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of the hosts or any of their affiliates. This podcast is for commercial and informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities or cryptocurrencies, nor is this an offer or sale of a security or cryptocurrency. DeFi Dad, welcome to the podcast.
Hey, thanks for having me, Caitlin. Yeah, glad to be here.
Super excited about this. And I have to start by asking about the name. So how does one get called DeFi Dad? Was that self-proclaimed, or did you get named that after you started doing everything in the education space? What's your origin story there?
Yeah, so I got into crypto in late 2017. I had truthfully never really spent any time trying to learn about Bitcoin up until then. I'd heard of it and kind of knew that it was digital money, but really never paid attention. And then I had a friend who I worked with at the time in a pretty typical sort of early stage tech startup in the Bay Area. He was pushing that I should learn more about crypto, and just like that it was a mashup of all these ideas and topics that would be interesting to me. And I truthfully always think back to that as like, what like a fork in the road is that someone aggressively pushed on me, like, you really need to learn about this. He showed me a video of Vitalik at the time. The video was pretty old already. It was about 2 or 3 years old, and it was Vitalik explaining Ethereum. And I just started to ask more questions, like what exactly is the purpose of all of this? The name Ethereum too sounded really sci-fi to me. So I something about it caught my attention. So fast forward, at the time we had about a 1-year-old baby, our first son. And as I would put him to bed at night, I would normally rock him to sleep. And so in doing that, I had a lot of time to pass. And so I started reading about crypto. I would listen to podcasts, read white papers, kind of do the thing that I think a lot of people do in getting started. There's a lot of self-learning. And if you fast forward then, I would say into maybe December 2017, I had started to buy small amounts of crypto. I didn't have anything substantial. I was kind of just dollar cost averaging in, but I was reading more. And I was at least trying to convince myself that it wasn't about the number going up, that I was really interested in the fundamental impact of crypto at the time, which was, again, mainly for me, it was Bitcoin and Ethereum. And so by the new year, the markets are crashing, everything's falling apart. My little portfolio that had grown a lot in just a few months, it had grown more than I'd ever seen stocks grow in my entire life, suddenly was crashing, and I was just as engaged. I felt like I wanted to learn even more. I recognized that I, might have bought at a less ideal time, and I started to pursue finding a full-time job in the space. And so by mid 2018, I had basically stalked down a job recruiter at Consensus, gotten them to hire me as I was kind of like a marketer across lots of teams, but also like a project manager. So I wasn't a technical contributor. I wasn't a developer, which was very hard to find jobs for at the time. And so for the next 2 years, I would then work at Consensus across lots of teams, but most specifically, I got to be a part of the leadership team for a conference called Ethereal, which is very much like a TEDx event, but for Ethereum developers. And this is where the DeFi Dad finally comes in. In spring of 2019, I was already watching Twitter very closely. I had figured out that all the information, the most like cutting edge information, was actually being shared in the crypto community on Twitter. And I started to, just reshare and post tidbits about new DeFi applications that I was trying. And at the time, basically nothing existed. I mean, there was Maker, there was Compound, had like maybe 50 million in it in the summer of 2019. And so the fact that I was using it, I was starting to deposit small amounts of DAI into Compound, or I was starting to play with Pool Together. Zerion was like I think it was the only DeFi dashboard at the time. And so I quickly realized like I might be doing something that no one else is doing. Like even at Consensus, there were boatloads of colleagues who were just, of the mindset that we had many, many years before crypto, specifically Ethereum applications, would ever become useful. And meanwhile, I was like, I'm earning 20% on DAI, which was, like a mind-blowing opportunity because interest rates in the traditional world were super low at the time. So I started in posting all of these, guides and simple like screen shares of how I was using the applications. By like December, DeFi was like really starting to, I would say, blow up in the mainstream of crypto. There was more people starting to realize there was opportunity. And so anyways, yeah, I think at the time I had an anonymous account that said Crypto Dad, and there's like a bunch of crypto dads out there. So I rebranded as DeFi Dad. And I gotta say at the time it was a very mindless decision. I love DeFi. I thought it was like the first killer product market fit for Ethereum specifically, and really for crypto beyond just speculation. And yeah, it's funny now. Even though DeFi has died down in terms of the euphoria compared to 2020 and 2021, I think obviously it's in the very first inning or two of its life, and yeah, I'm very bullish, obviously, on the growth of it in the coming decades.
You teed things up perfectly for me, just because this is such an important episode, and I'll try to stay off of my soapbox here, but for understanding the entire movement of crypto as a whole and kind of the changes that this technology is trying to implement and just really create a system that's more efficient, can do things in a way that we haven't seen in the legacy side of things. So I want to start out with a very simple question, and that is, what is DeFi? How does it differ from the centralized financial system as we know it?
All right, we start to work through these very simple but somewhat hard questions. Okay, so to totally dumb down how I think about DeFi. DeFi is digital finance that is powered by crypto assets. So there is like a digital scarcity to this, and it's settled on a blockchain. And all of the interactions that mirror parallel, traditional finance use cases, they're allowed to happen in a trustless manner because of the way that a blockchain works. So it really just means that we're redesigning finance so that we don't have to have as many of the middlemen or middlemen at all. And we can basically depend on software that automates the way that you would use, again, money in the traditional world. The way that it differs, I think I started to sort of touch on that. One of the most obvious is it's permissionless. And that word permissionless just means you don't have to ask permission or be granted permission to use this. And so DeFi, real DeFi, pure DeFi, not like DeFi use cases that have been adopted, let's say, by a centralized exchange. DeFi is where I can permissionlessly access an application. Normally, I use something like a web browser wallet like MetaMask. As long as I've got an internet connection, though, as long as I can go through the steps of setting up a crypto wallet like MetaMask, I can get onto the Ethereum network or some other similar networks, and then I can start to access these different applications like lending, borrowing, and trading. The nature of those protocols goes back to what I was explaining earlier. They have to be trustless. So I would think of it as just automated software that can essentially run without any input from us or any other like third party. You should be able to get on there and lend without, somebody clicking a button on the other side. And then what's really interesting about this is these are systems that are designed to act like a flywheel. They're designed to incorporate incentives that keep everybody sort of working together so that, for example, you can lend, but you can know that, for example, if I'm a borrower, there's an incentive for me to pay back my loan or else my collateral will be liquidated. And as a lender, I'm obviously, risking depositing my money in order to earn interest from borrowers. So I guess to sum it up then, like DeFi compared to the traditional finance system, it's faster, saves you time, should save you money, should offer you ultimately better rates because of all of the costs that are saved operationally. And in many cases, it allows us to do things we otherwise could not do. There's a lot of DeFi use cases which mirror the types of services that very wealthy people have had access to for a long time. Being able to just borrow against things that you own, whether it's like, let's say, property, or let's say you have a portfolio of stocks you want to borrow against. In DeFi, you can go in and essentially put up tokenized value in the form of, let's say, multiple tokens on Aave, and I can just borrow against it instantly. So I'll pause there, but yeah, hopefully that starts to give you a sense of some of the differences.
No, it's perfect. And I think this is an interesting time to be talking about it because we've seen DeFi is thrown around everywhere, right? And you just explained what it is, which is obviously helpful, but we've seen a lot of experimentation in the space too. And to your point on like the core DeFi projects that are being worked on, a lot of it is just taking a lot of the necessary functions in the traditional world, lending, borrowing, trading, and bringing them, again, to your point, a way that's faster, cheaper, more equitable, easier to access, hopefully for everyone that has internet connection anyways. And in terms of use cases, I kind of want to dive into that a little bit more just because we see a lot of experimentation, which is a necessary component in any space and getting that up and running and having new innovations and whatnot. But what are the most common use cases of DeFi today? And just for people who are just starting to learn about it, just coming to DeFi, how would they most commonly interact with that?
Yeah, good question. So I'm going to go super basic on a few of these and then call out, I think, some of the more like advanced use cases, but they're very popular in DeFi. So I think first off, just being able to store value that is digitally scarce is very valuable. And I think, to be fair, Bitcoin on the Bitcoin network, that original use case of having digitally scarce value, being able to send it, like that's the original DeFi use case. Now, when you see Ethereum launch, Ethereum now allows us to use smart contracts, which essentially say if this, then that, which allows you then to ultimately program all sorts of different like money applications or what we call money Legos. So the second, I think, most obvious use case beyond like a store of value is a medium of exchange. And I think the real like breakthrough on Ethereum was that when the Maker protocol was created, I think it was launched in 2017, or at least was in development at that point. Maker allowed us to store a certain amount of ether and to borrow a lesser amount in a stable coin that is pegged to the US dollar. And it, by the way, it could be pegged to all sorts of other currencies in the future. But for right now, stable coins still tend to be associated with the US dollar. And so that's a very powerful use case. In fact, I'd have to look up on CoinGecko, but the amount of stable coins that exist today is just mind blowing. I mean, I believe we're in hundreds of billions at this point. I'm trying to look it up here right now. But anyways, those stable coins were a breakthrough because even going back to 5 years ago in let's say 2017, if you were going to send value, if you were to, let's say, exchange fiat, like a US dollar for Ether, if you did that on an exchange like Coinbase and you sent it to another exchange, and the whole purpose of this was really just to, transfer that value, when you're dealing with volatile assets like Ether or Bitcoin or really anything else that is not, pegged or stable, you're dealing with, potentially your value going up or down in that time. So, we live in a world where most of us are dependent on some sort of fiat currency, the US dollar being the most popular of those. And so this is huge. This is bridging the legacy world to the world we live in now. And I think it's probably one of the use cases we most take for granted nowadays. So once we get past that store of value, medium of exchange, which sort of incorporates to all of the benefits of self-custody in a crypto wallet, having total control of those assets where no one can access them unless they have your private key or seed phrase, which you should never share with anyone. You then get into trading. So 5 years ago, if you were using Binance, Coinbase, whatever, most trading activity happened on centralized crypto exchanges. Nowadays, while those have continued to grow, and those services have clearly grown the crypto pie, we have a tremendous amount of activity now that's shifted to on-chain with what would be called a decentralized exchange or an automated market maker. The darling of that category tends to be Uniswap. Uniswap allowed us to start to market swap or market trade two different tokens. And interestingly enough, it also created a model where we could become liquidity providers and earn a share of the trading fees just by depositing the two tokens that were going to be traded in the pool. So if you wanted to trade Ether and DAI, you had to have someone else who was brave enough to deposit an equivalent amount of Ether and DAI. And then as folks are trading between those tokens, you're earning a portion of the trading fee, which the Uniswap protocol was charging. But the point is here's an example of another use case which has created incentives that allow two or more parties to come together, and all of the interactions are essentially automated and they're provable thanks to cryptography and everything else that sort of goes into using digital assets. So I would say trading was probably the third largest. I won't go as into detail about this, but it's worth noting that decentralized perpetuals was a big sort of category, less common for the average person to use, but back in the day, like the DYDXs of the world, which really I want to say DYDX was probably one of the few, they were sort of pioneering the fact that you could trade with margin, or that eventually you could trade with a perpetuals market and be able to have leveraged exposure to something like Ether. You could long it, short it. These are really powerful use cases that you would otherwise have to normally go through a centralized service in the legacy world. And previous to that, you didn't have the access that you did with cryptocurrencies. But with DeFi, you have all the benefits we talked about earlier. It's permissionless, it's trustless. It doesn't matter what geography you're in. As long as you have an internet connection, you should be able to access it. And then I would say the final use case, like worth noting now, and again, there's lots and lots of other use cases, but if we're talking strictly DeFi, we're not going beyond the boundaries of DeFi into like gaming. There's lending and borrowing. And Maker, I sort of touched on it earlier with them pioneering the idea of a stable coin that was over collateralized with Ether and pegged to the US dollar. But Maker really made it possible for us to put up a store of value, Ether, and borrow against it in the form of a stable coin. And that's huge, because that's a huge part of what allows most to accumulate wealth. If you find a good store of value, I think like any very wealthy person will tell you, you want to sit on that long term. And if possible, you want to be able to borrow against it so that you don't trigger, taxable events along the way. And so Maker was just a huge innovation. Following that, though, we had what should more appropriately be called money markets, where you have two sides, lenders and borrowers. And that is just a magical sort of use case. Like the fact that, in the summer 2019, I was, screaming at my friends, like, I'm earning about 20%. Like, this isn't a scam. It's actually all very transparent. I can see on chain, like, where the money is. I'm assured getting my money back pending some sort of like black swan event. I'm assured getting my money back because the protocol is holding more money than what borrowers have borrowed, and they can liquidate that if these people don't pay it back or maintain their loans. And so I still think lending, I guess I would throw in there staking as well. Staking in the sense of a proof of stake protocol like Ethereum, where it relies on people staking Ether. Anything that allows us in DeFi to continue to hold something long term that we believe in, that we think will go up in value, and passively earn income or interest or whatever it is, something you call it like almost like a dividend in terms of some use cases. That's very powerful. That to me is just such a no-brainer. You're already long Ether, you're already long or happy to be holding a pile of stable coins because you need it for bills and everything else in your life. The fact that you can lend that and passively earn, again, interest or staking yield is just huge. So I'll pause there, but yeah, hopefully that gives you a sense of some of the most popular use cases.
Definitely does. And it's funny you mention stablecoins as well as probably one of the biggest applications there is of DeFi. And you're totally right. It's very much kind of you don't even think twice about it anymore. And I don't even know if a lot of people would consider that when they think of DeFi, but it's such a critical component of that entire ecosystem that most people just don't even give a second thought to. But I do want to focus on what comes up most from talking to the traditional finance crowd, at least in the past few years, or past year even, is the opportunity when it comes to yield. A lot of people looking from the outside in can't wrap their minds around how are these yields possible, first of all, without it being a scam. What's the catch here? Too good to be true. Maybe not sustainable. Maybe it is. But I think there's a lot of myth busting that needs to be done when it comes to staking and other opportunities to get yield in the DeFi space and how it's possible and how it works, because that yield is super attractive, especially when you look at an equivalent in the traditional side, whether that's like a money market or a CD, and the rates that you're getting there are minimal. Like the numbers are so small, and you compare that to the opportunities in DeFi, and that catches people's eye, but it really gets them, unless they're educated on it, usually pretty skeptical. So I don't know where you want to start there, but I think it's an important topic just to get through, how are these yields possible right now? Are they sustainable? I feel like the answer is probably no on some of the numbers we see these days, but how are they possible now, and how does it work?
Yeah. So lately, those yields have dropped a lot. We all know yields have come down as the economic activity within DeFi has gotten quieter and quieter since a few years ago. So why don't we talk about the problem about 2 years ago. The problem that was under the hood that was actually powering a lot of the yields, the numbers that everyone was focused on. I'm earning 200% APR, APY, whatever it was. These numbers that truly did look unrealistic. A lot of them were propelled by new tokens being created. So there were new protocols, and obviously there was a lot of excitement specifically around DeFi. And so there was an innovation there that I think will outlast, this past cycle, which was we should be rewarding those who are early participants in our protocol, who are willing to risk their liquidity, who help us to bootstrap liquidity. That's fine. The issue is when there's an expectation of outsized returns for participating in the protocol. And so what happened at the time is there was a massive amount of speculation around certain tokens, many of which too, I would say, are still like the blue chips of DeFi. These are protocols that are very battle tested. They're going to be there, I believe, years from now. They are the sort of foundational building blocks of DeFi, but nonetheless, they suffered from over speculation, which eventually resulted in, call it a bubble popping, or a typical sort of crypto market drawdown of 85 to 95% in token value. And so a simple example of this was Compound. Compound kind of kicked off what was referred to as DeFi Summer. They enabled you as a lender or borrower to earn a portion of their comp token. So they basically said, hey, everyone, we've been running this protocol, ourselves as a core team, but this thing is meant to be community owned. We would like it to be community owned by those who are the users, along with us as the core team and other investors that were already involved. And so it would be like Google rewarding people in Goog, the stock, for searching. If you could earn like fractional amounts of it, which would clearly be wildly popular among users of Google. In DeFi, specifically here with Compound, we had users who started to earn the comp token. And what's really radical about this is you were earning it in real time and could instantly claim. And because it's an ERC20 token, it means that it can be tradable now on any DEX where people are willing to provide liquidity. So at the time, it was Uniswap specifically, and a few other AMMs. As soon as that comp token went live, that there were folks who were willing to put up that comp token plus, let's say, Ether or like a USDC stablecoin. And now you have a market. You have liquidity providers providing liquidity. You had those who were obviously wanting to cash in on that early comp token, and you had others who wanted to buy it and speculate on its value. And this basically was like a rinse and repeat with countless protocols, many of which, today again are thriving and are exponentially larger than they were back then. But there's no doubt there was this like run up on the yield. Around that time, as this sort of like rinse and repeat process is happening, it's obviously minting new wealth for lots of different folks in the space. And so since you can essentially sell any token as long as it's a standard ERC20 token that is transferable, it just means now that you have money flowing in all different directions. And so at the time, you had lots of folks creating new wealth by being liquidity providers. In some cases, they were also earning airdrops as well. So there started to be like a retroactive reward for many of us who had been providing liquidity without any sort of expectation of a reward. And then that became a common practice as well. And so this concoction of new tokens, airdrops, to, I would say, a fairly small group, even though the DeFi space had grown a lot. We're a small group within the crypto space, and the crypto community is a small community within, the respect of the entire world. And so then you have, this new money that's being sort of, pushed around and reinvested. And during that time, to bring it back to the yields, as folks are accumulating new tokens, some of which they're seen as a store of value, even though they're totally new tokens, highly speculative, and they're finding support on, let's say a protocol that is a money market like Aave. They deposit that token and now they're borrowing against the token. And so that's creating increased demand for stablecoin borrowing. And that basically spreads across the space. And so now you not only have the unrealistic yields that are being propped up by newly created tokens that have highly speculative prices that are shooting up, overnight, but you have like real demand now that is going parabolic for stable coins. So despite the fact that, many of these yields would, eventually go down over time, in some cases they're fleeting. These are yields that might last a few weeks and eventually a few days, and in some cases, minutes before the yield would get diluted. You had this increased demand for stable coins. And so since the, let's say 85 to 99% drawdown in certain tokens, per usual in a crypto, bull to bear cycle, we're still left with that many more participants, that many more builders, that many more investors. And so the space has grown, exponentially since the last cycle. There was no DeFi in the last bull run, prior to this 2020, 2021. And now we have very well established, I think, product market fit. This is a home for many of us. Like this isn't alternative finance. Like this is the home base for us as finance. And basically most of us, I think, in this space see off ramping into something like the US dollar. Like that's leaving the home base because we've got to pay rent or mortgages or whatever bills you have to pay in your life. Until, of course, you sign up for a crypto-powered debit card that hooks up to a crypto wallet like Juno, which I was just playing with today. And by the way, that's not a referral,
not an ad,
a shill. Yeah, I have no upside in it. I'm not invested. I have no referral link, but I just I played with this morning, and I was like, wow, like this is the sort of thing that bridges that many more users into the space. So fast forward anyways to today, the state of yields in DeFi is still, I would say, rather impressive, despite the fact we're clearly in a recession in terms of like global equities markets. There's all sorts of scary things like, the threat of a World War III. And yet DeFi is continually seeing new protocols launch. There's a lot more experimentation that's coming, partially because the first phase of DeFi launching was we needed these foundational money Legos that are, things that we can truly rely upon, that can be stress tested in markets that draw down 90 something percent and survive, really like, I would say, scary times in global markets. And so we have that now with the likes of like a Maker or Compound or Aave, Uniswap, Curve. All of these sorts of protocols are making it possible now for new founders to think, what's the next innovation now that we have these that we can rely upon, that are composable and we can sort of build with. And again, I would think of them like Legos. But these are the base Legos, and those you can't do all the cool stuff, and start to create newer and newer applications if you don't have a foundation that's reliable. And so the yields today, I would say mostly in 2022, in this sort of like macro environment, the yields are mostly, first off, they're staking. And this is purely, in my opinion, for proof of stake protocols like now Ethereum, where there is a reward for contributing to helping the chain basically come to a consensus and settle transactions. And so staking ETH today is, I think, around like 5% if you're using a liquid staking derivative. Second is good old lending. You can still lend on like a Compound or Aave. Those yields have gone down a lot. I mean, if you're lending USDC or DAI, you're probably earning 1%. It's pretty pathetic right now. However, there's newer interesting protocols like I recently reviewed this one called Morpho. It matches you peer-to-peer for lenders and borrowers, and it makes Aave and Compound more capital efficient. So you end up lending at a higher rate and borrowers borrow at a lower rate. So good example of the type of like next generation of DeFi that's coming. And then I would say the last one is still liquidity liquidity provisions. So there's, I think, a lot of money to be made if you are long at least 2 tokens and you're willing to incur the what's referred to as impermanent loss. You can go into something like Uniswap or there's all sorts of other new AMMs that are out there. Balancer is another really popular one that has added benefits. You can basically deposit 2 tokens in most scenarios in different ratios. And then if I'm willing to do that, I'm earning a percentage of the trading fees. The issue, of course, is for someone like myself, like, am I willing to risk putting Ether paired with something like a stable coin? Because as the market is buying back Ether, I'm technically selling it to the buyers. And then as the market is dumping, I'm technically buying up Ether and giving them my stable coins. So you have to be willing to make the opposite play of where the mass market's going as a liquidity provider. But that's why LPs are great for those that are long certain assets and want to sit in it forever. And then if you're doing any one of the things I mentioned, there tend to still be liquidity mining rewards. So you can still get paid for providing liquidity, whether it's lending or being like an LP in an AMM. In most cases, you just have to go out looking for it in places like Convex or Concentrator. There are these like yield aggregators that basically help you to automate auto compounding the yield that you're earning. So I'll pause there. Does that, I just gave a lot there, but hopefully that's all making sense.
You laid that out perfectly. And the natural follow-up with all of the cool things that you just described, which versus, what we see in traditional markets is just like mind-blowing and so many different levels for many reasons. But the biggest question is, how do you regulate that? And I'm not expecting, they're still being worked out, right? But there's so many innovations being built and so many things that have never been done before being done in a decentralized ecosystem where anyone with a computer has the potential to really up and build something new that other people can interact with and the assets can flow into. So from a regulation standpoint, what are the current issues potentially being faced for builders in the DeFi space? How are regulators approaching this, at least as a starting point in the States?
Yeah, there's a real disconnect right now with regulators. I would say if anyone watches this, I would love to speak with any regulators. I'm very friendly and would love to help educate you on how some of this works. The cool thing is a lot of DeFi actually will be easily understandable for the most part for regulators because it mirrors most of the use cases they're used to regulating in the legacy world. The issue, though, is I think wrapping their arms around how can we do our job as regulators, but not stomp out innovation, scare founders from wanting to work in this space, basically put guardrails on that will prevent the space from developing as a public good. And that's the disconnect today, is that DeFi is very powerful for those again who I think didn't inherit a lot of privilege from the legacy system. Now, I don't deny the fact, like in the legacy system, if you have more money and everybody's earning the same yields, obviously you stand to gain more as an absolute amount. Like I can earn more yield if I have more money in DeFi than someone else who doesn't. But my point is that DeFi is accessible to anyone who's brave enough to basically set up a crypto wallet, connect the internet, and is willing to click, and deposit any amount of digitally scarce value that they hold. So one of the things that's starting to happen is I think you're going to see more lobbying from the crypto community as a whole, specifically DeFi in Washington, D.C. So by the way, too, as we talk about this, I'm thinking specifically in terms of the U.S., but a lot of this I think can be applied to elsewhere. So there's a lobbying aspect. I think there need to be some like landmark court cases, as in like potentially lawsuits that will help to set precedents around how crypto should be treated. I mean, one of our biggest obstacles right now, and like, I don't wish ill upon him, but Chairman Gary Gensler of the SEC is just incredibly difficult for us to work with. He has a very old school view that basically the way that they have operated for a very long time, going back to like early 1900s, that sort of policy and thinking should be applied to today. And, obviously we live in a world now where you have a supercomputer in your hand. And, we live in a world where I think it's very likely that in the future, we'll have a very vibrant sort of virtual reality metaverse that people will opt into over the physical world just because of all of the benefits of it. So my point is just technology has advanced, and it seems that our policymakers, not all of them, some of them are clearly doing fantastic work, but quite a few of them have not advanced with the times. The way that we oversaw travel by horse and carriage didn't make sense for the way that we would, think about highways being built and, the safety of newly created automobiles in the 1900s. And so I think there's a clear parallel there. There's also some lessons too to learn from the even as recent as the 1990s. There was a government there that was much more friendly, despite some parallel issues, but was much more friendly to the innovations of the internet. And, the internet was able to grow, and we were able to see this as basically a public good. But the difference now is, because of the tokenized value aspect, these new networks can be actually community owned from the start, versus what the legacy internet is mostly centrally owned by a few very large entities. And so that's the real difference here. But it feels like Chairman Gensler specifically sees this all as, essentially a get-rich scheme by the majority of those in this space. And it's just a very like poor attitude to bring to the table. And so I hope that others see flaws in his approach. And again, I wish him well. I would love to be able to, provide feedback in the future to, folks like him who are thinking about how do we, again, do our job as regulators, but not stomp out like the inevitable future that is coming with crypto asset powered digital finance.
It's a big question too, right? And it takes a lot of, it's got to be thoughtful, right? Pave the path forward, and not, to like what you said before, drive people from the US to more regulation sort of crypto friendly jurisdictions, which, the train's already left the station on it, right? You're not going to back up all of this innovation and just completely take it away. It's not feasible. So how regulators face this is going to be super critical. It's been interesting to watch. We're living through a very interesting time right now in many ways. You mentioned risk of World War III being another one, but just a lot going on. So lots to watch, every single day. I feel like there's something new on that. And, the current market environment is also very interesting, which is another thing that I wanted to touch on. You mentioned this too. We're in a bear market. And how is this bear market that we're in today differ from what we've seen in the past when it comes to crypto markets? It's obviously cyclical, but I think how we've seen people in the space interacting in the past 6 to 9 months, how we've seen the markets kind of moving as well is a little bit different. So maybe if you could touch on that for more current events type of discussion there.
Yeah. One last thing to note on the regulators. I think it's important that we have to help regulators and other policymakers. We have to help them to see themselves in this space. It has to resonate with them. And so I've been very grateful when we've run into policymakers who clearly have young kids or, young adult children who are using crypto. Those people bridge the gap, because they're showing them and they can see the excitement and the sort of opportunity that their, someone that they trust, let's say their children, brings to the table. And so, I think some of I don't want to call them real world use cases, because I still think DeFi probably grows exponentially and thrives off of use cases built for those that are already here and for those who will onboard into this default digital economy. But a few that come to mind that I've recently been thinking these people can really help folks who are much more comfortable with traditional finance see the light. So Maple Finance is one that does unsecured or under collateralized lending. And they only do it to market makers, funds, institutions that have such a credible sort of track record that there's minimal risk. There's still risk, but there's less risk to them defaulting on a loan. And so that's been one. I think again, anything going back to any sort of lending, feels like a use case that should get them excited. I still think Pull Together is one of the most interesting gamified DeFi approaches, because the lottery, which in most parts of the world is very popular, is, eating up common people's wealth, and it's, in my opinion, it's a scam. The lottery is all about preying on, your hopes and your dreams that you'll get rich, but the probability is you'll never win. Now, why are we okay with giving people the freedom to do what they want with that money, to play state-run lotteries and put up, in some cases, hundreds of millions, if not billions of dollars gambling? That's what the lottery is. Whereas you have something like Pull Together, which harnesses the automation and the power of DeFi to say, how about we all just deposit our money? We will take the pool together and we will deposit into something like Compound, earn interest collectively, and then that interest will be rewarded to some random winner. However, you all can withdraw your money whenever you want. You don't stand to lose your principal. To me, this is an example of the, again, trustless sort of automation of DeFi. And so, yeah, I still swear Pull Together is just this killer sort of breakout use case that I'm hoping more people get on board, especially older generations. Probably the last one in there is going to be gaming. I think gaming will also sort of bridge the gap. And I think that if you're a policymaker, a regulator, and you've got kids, be prepared for their games to be empowered by, tokens, whether it's an NFT or just a standard token. Okay. So anyways, that all being said, in terms of markets, I guess what is, remind me again, what's the question here about the current state of markets?
How does this bear market differ from the bear markets we've seen in the past when it comes to crypto?
Yeah, that's right. Yeah. There we go. It's just blabbering on about God knows what. This is really easy. Nice short answer. The main difference is we have that many more participants, both builders and actual investors, evangelists, users, whatever you want to call them. Another major difference is, we used to live in a world that was very limited in terms of the use cases. And I would say it was mostly just buy and hold. And it was all through centralized exchanges. Now, of course, we have DeFi and we have all sorts of other Web3 use cases, whether you collect art, whether you want to buy some, music as an NFT, whether you want to play a game, games being still in early development, but we have lots of Web3 games that will allow us to essentially play a game, but have a little more freedom, potentially have a token that you can, cash out or use to buy something else. Maybe you earn an in-game asset. For me, I've mainly been focused on a few different trading card games, specifically Parallel, because by the way, I hold Parallel cards and so clearly have upside in that. So this isn't a recommendation or endorsement to invest in Parallel cards for any sort of return, but it's a card game. It's a trading card game like Magic. And so that's been a really fun one for me to realize that I'm buying this early art and I'm treating it like art, but in truth, I'm excited to play the game. And actually, I have lots of friends now that are playing the game in early beta, and they're just having a blast. They're not talking to me about the values of cards. They're talking to me about Parallel, the trading card game. So those are the major differences. Just really strong product market fit. The last bear market was so boring. There was nothing to do. You just basically got more and more depressed, realizing between January 2018 and I would say most of 2019 until really DeFi took off. I'd say maybe mid 2019. It was depressing. It was a very hard time. There was a true existential threat of is this all going to go away? Was this all a sham? In 2016, 2017, and then I guess the last major difference to call out is layer twos, the fact that we have layer twos and other thriving L1s that are, growing their own DeFi and Web3 economies. The fact that I don't have to focus only on Ethereum, it's still to me the most active from an economic standpoint. It's kind of like New York versus, another major city in the world, in terms of finance and everything else. If you think of Los Angeles, Hollywood as the center of the film and TV industry, I mean, what's to stop another city from fostering that sort of strong network around creativity and creating TV and movies? And so similarly, in terms of Web3 and DeFi, we're now at a place where it's not just Ethereum mainnet. There's, interestingly, I would say the L2s like Optimism and Arbitrum that are optimistic rollups, or ZK Sync 2.0, which is launching soon. That'll be another L2 that inherits the decentralization and security of Ethereum mainnet, but allows you to have the speed, the lower cost of transacting. It's just wild that we have so many options, so I can't even imagine what, another few years is going to look like. There's a number of chains that are, they pale in comparison to the growth that I think is on Ethereum, but you have economies that are not going away, like an Avalanche, a Solana, Cosmos has all sorts of different app chains that are in development, a few that are thriving like Osmosis. By the way, everything I just mentioned too, I don't have money in any of these things, so I'm just calling them out. I do hold Ether, obviously, but yeah, just kind of calling out some of the other really exciting communities to track.
It's sort of the paradox of choice. There's so many different projects being built, so many coins and tokens and projects that you can be investing in at this point, even in a bear market, that it's kind of overwhelming. And I think if you're resilient enough to make it through the bear market that we're in right now and see kind of what comes out on the other side, to your point, a lot of what's here is going to stick around. So it's definitely, an interesting time, but it's still an exciting one, even when markets aren't looking so hot. And builders are still building, which I think is super important. I think we could probably keep talking all day, and at the risk of cutting things short here, cutting things before they get too long, rather. I always ask my guests the same ending questions, and they're sort of big ones, more on speculating on the future of the space and best case, worst case scenarios for crypto. And for this one, I'll make it specific to DeFi. What would you point to for if DeFi does blow up in a big way, in a positive way? What will it take for it to see that long-term success? And if we look the other way, on the other side of the coin, if DeFi were to just implode, if it were to, never reach the potential that we think that it should for all of the reasons that you've talked about in the past hour, what would you point to as the reason for that being? So basically, what are the risks there that, DeFi faces? Long question.
I think one of the risks. Oh no, it's okay. No, makes total sense. I think one of the risks we've already overcome. There was always this risk of something becoming like too big to fail. I guess that tail risk always exists. Could when we saw Ethereum transition to proof of stake, there was a lot of worry. Just what if? There's a very small likelihood that something could go wrong that would truly bring the whole crypto community or the Ethereum community to its knees. But even at that point, we had mitigated that risk. There were always backup plans if something were to go wrong. So there's been events like that have continually been overcome. And the fact that we have so many participants in this space, it's just a lot of skin in the game. If someone said, tomorrow, Ethereum is going to be outlawed in the United States, no one is allowed to use it, that would be a huge hit, on Ethereum specifically, or any chain. But there's really nothing to stop a majority of the rest of the world then from accessing it, even if you make it difficult. And also too, thinking about all the skin in the game, if that hypothetical scenario even happened, you'd have people moving out of the United States. And so there is a balance of incentives there that at this point, there's so much that's been built. There's so much skin in the game. It's going to be, I think, next to impossible to put the genie back in the bottle and tell people to forget about what they're working on, what they're building, what they believe in. There's almost like a cult-like, I would say religious-like following in crypto that you're a part of something that is bigger than all of us. It's a mission that should have a positive impact on, everyone if we're successful. And that to me, that's probably one of the most special parts of the crypto community that sort of drives us forward. And I'd say more specifically to Ethereum and a few other niche communities within the crypto space. I would say one event, though, that falls in line with that sort of high risk, too big to fail, brings us to our knees was Terra, the collapse of Terra. I've never seen anything like that, where a stable coin, goes to zero in a matter of a few days, almost overnight. It was about 20 billion, I think at the time, 20 billion of UST. I don't have any flashy numbers to compare to that, but if you look at the destruction of wealth from the Fed hiking rates and all sorts of other factors, not that they're all to blame for it. If you look at the amount of value that has been, we'll just say, destroyed in the stock markets, I mean, this is nothing. This is this is something of nothing, in comparison. And so, yeah, I think if you have that perspective, you realize that the crypto space, I'd have to check now. I think are we under $1 trillion in total market cap right now of all cryptocurrencies? Yeah, 981 billion as of today, October 7th, 2022. So, we're not even a trillion. And, if you look at comparable markets and you consider the virality of this technology, the fact that it's open source, the fact that hence it can grow as long as people have a connection to the internet and want to gain access to it. I think this is the crypto space in general, not all cryptos, but the major sort of crypto assets that act as the native token of the major protocols that make up crypto. It's hard to imagine that we're not going to see market caps in total that exceed all of the different parallel markets that define our world today. I wouldn't be surprised if for example, we always compare to gold. There's no doubt whether it's Bitcoin or Ether or all of them together, it's absolutely going to exceed the market cap of gold. It's just it could be a few years out, could be a decade out, but it's definitely coming. There's no way that a technology like this is going to stop growing. And what's different is that this technology has a price tag to it, in terms of a community shared fractional ownership through tokens. So yeah, it's like I feel to sum it up, I don't think anything can stop this space from growing in the coming years. There will be bumps in the road. I would say anything short of like World War III, which again is scary because there's actually a greater likelihood of that than probably ever before in our lifetime. But yeah, anything short of blowing up the planet, I don't think it's going to stop crypto.
We love it. We love it. And we have to wait to see. So we'll see how this pans out. Really excited about that, obviously, in the future of everything that you talked about. It's just super exciting to me. I hope it's exciting to the people listening to this. And I have to say, I'm biased because this is my podcast and I asked you to be on it and I worked on the questions for the podcast. But this is one of the best DeFi 101 walkthroughs that I have heard. And I think it's a super critical component of getting traditional finance professionals to onboard into the space. One of the biggest parts of onboarding is education, which I know you do a lot of work around, which I really appreciate. And of course did on the podcast today. So thank you so much for coming on and taking the time. Thank you to everyone for listening in, and we'll be back next week with another episode.
Awesome. Thanks for having me, Caitlin. And by the way, if anyone is a builder in this space or knows a builder, one thing I left out is I now work full-time at Fourth Revolution Capital. So we're a venture fund that focuses specifically on early stage DeFi and Web3 startups, also specifically within what I would call the Web3 media space, which includes Web3 games as well. So if you're an early builder, please consider getting in touch with us at fourthrevolution.capital.
All right. Well, thank you again. And thank you to everyone for listening. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of the hosts or any of their affiliates. This podcast is for commercial and informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities or cryptocurrencies, nor is this an offer or sale of a security or cryptocurrency.